Gold gapped down $40 before New York even opened. Silver dropped nearly $2 in thin Asian liquidity. The Strait of Hormuz closed again over the weekend. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Now, both metals are trading below Friday's close, and the macro picture just flipped overnight. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today: the Strait of Hormuz. The U.S. Navy seized an Iranian-flagged cargo vessel in the Gulf of Oman on Sunday. Tehran immediately reversed its decision to reopen the strait. The ceasefire framework that markets celebrated on Friday collapsed within 48 hours of being announced. Oil surged. The dollar index climbed to 98.31, up 0.21% on the session. Spot gold opened at approximately $4,130 before pulling back to $4,809. U.S. gold futures for June delivery fell 1% to $4,129.40. Spot silver retreated to $80.13, down from Friday's close near $82. Front-month COMEX. May silver futures last settled at $79.90. The gap has already materialized. The timing is what deserves scrutiny, not the event itself. The timing. A 10-day ceasefire, announced Friday, collapsed Sunday. Markets had no opportunity to adjust positions in between. Think about what that sequence actually means. Long positions were maximally extended at Friday's close, multi-week highs in both metals. Then the Hormuz news drops over the weekend when zero liquidity exists. Stop-loss cascades at Monday's open in thin Asian session trading. The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. The last time COMEX silver registered inventory fell to these levels and the Shanghai premium simultaneously exceeded $10 per ounce, it was within months of a structural repricing event in the physical market. The data is already telling you something. Let's build it out. Now let's build the full picture because the Hormuz closure does not exist in a vacuum. Shanghai Gold Exchange data shows silver trading at $92.16 per ounce as of April 17. The Western spot price on the same date, $81.49. That is a premium of $10.67 per ounce, 13.09% above the COMEX paper price. The 6-month average Shanghai premium is $6.98 per ounce. Today's reading is 52% above that average. That number is accelerating, not stabilizing. COMEX registered silver inventory, the metal carrying active delivery warrants, stands at 76.88 million ounces, confirmed by CME Group official warehouse reporting. Total silver futures open interest stands at 575.5 million ounces. That produces a coverage ratio of 13.4%. Below 15% is the institutional stress threshold. The May contract alone carries approximately 235.2 million ounces of open interest, with first notice day now 8 business days away. According to Blowfin Research, the 13.4% coverage ratio is the lowest since stress conditions were last flagged in the delivery cycle. Year over year, silver spot has gained 144.78%. Gold has gained 39.96%. The rate of registered inventory depletion is not slowing. It is accelerating. The data is doing the talking. The ones who have been called alarmist for pointing to the Shanghai premium and the COMEX coverage ratio, they are not saying much right now. And here is what makes that picture even harder to ignore. The gold-silver ratio currently sits at 59.7. It hit 107 at the 2026 extremes. Silver has already closed 44% of that gap. At the same time, COMEX paper open interest remains at 575.5 million ounces, while registered supply sits at 76.88 million ounces. That is not a contradiction. That is the setup. Paper claims on silver outnumber immediately deliverable metal by a factor of 7.5 to 1. And before anyone takes that as a green light for immediate entry, Setups can take a long time to resolve. What this tells you is the structural picture. The timing is a completely separate question. Anyone who claims to know the timing is selling something. The structural pressure is real. The resolution timeline is not knowable. Sit with that. Now the macro variable, because this is no longer a backdrop, it is the primary variable. Here is the number most people are not discussing today. The Strait of Hormuz handles approximately 21 million barrels of oil per day. Roughly 20% of global oil supply transits through one 33-kilometer-wide waterway. When that waterway is disrupted, energy prices reprice. When energy reprices, inflation reprices. When inflation reprices, central bank policy reprices. When central bank policy reprices, every asset class reprices. The March CPI reading confirmed this chain is already in motion. Consumer prices rose 0.9% in March alone, the largest single-month increase since June 2022. Annual CPI hit 3.3%, the highest since May 2024. Core CPI rose to 2.6%. The Federal Reserve is universally expected to hold rates at 3.50 to 3.75% at the April meeting. CME Group FedWatch data shows essentially zero probability of an April cut. The 10-year Treasury yield fell to 4.23% on Friday as markets briefly priced in easing. It is rising again Monday as oil surges on the Hormuz closure. Markets are still pricing a partial de-escalation. Look at the gap between Friday's ceasefire optimism and Monday's military seizure of an Iranian vessel, and tell me what probability you put on a smooth diplomatic resolution this week. When markets start pricing the reality of a sustained Hormuz disruption, gold reprices higher on inflation and safe haven demand. Silver reprices through a combination of industrial demand destruction risk and physical squeeze pressure simultaneously. That is the historical pattern. Every time a supply shock of this magnitude has occurred, it has not been different yet. Gold Western spot at $4,809 to $4,830 per ounce. COMEX June futures at $4,829.40. Shanghai silver at $92.16. Western silver spot at $80.13 to $80.36. The 1067 premium is not closing. The short-term picture is binary. The Hormuz situation resolves, or it does not. If genuine diplomatic progress emerges from the current talks, oil falls, yields fall, the dollar weakens, and metals recover toward Friday's highs and beyond. Gold targets $5,000, silver targets $85 to $90 near term. If the Hormuz closure persists and the U.S. naval blockade holds, oil stays above $94 per barrel. Inflation expectations remain elevated. The DXY recovers toward 100 to 102. 10-year yields push above 4.60%. Gold compresses toward $4,600 to $4,700. Silver tests $72 to $75 support. That is the only short-term read that matters right now. As for trading it, I cannot see a clean picture on the lower time frames right now. I cannot tell you what silver does tomorrow. Nobody can. The gap has already happened. Whether New York liquidity stabilizes prices or accelerates the move lower is not something any analyst can tell you with certainty today. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. 1. The DXY at 98.31 is rising, and every dollar index point higher compresses dollar-denominated metals directly. 2. The 10-year Treasury yield is rising Monday as oil pushes inflation fears higher, reducing the relative appeal of non-yielding gold and silver. 3. The silver gap from $82 to $80.13 has already materialized on thin Asian liquidity, and a New York continuation lower toward $77 to $78 is a live scenario if Hormuz headlines worsen. The bull case is equally real. 1. COMEX registered silver at 76.88 million ounces against 575.5 million ounces of open interest is a 13.4% coverage ratio that is objectively in institutional stress territory. 2. Shanghai silver paying 1067 per ounce above COMEX is a physical market signal that arbitrage has failed, which means real metal cannot move freely between East and West. 3. Money managers increased bullish gold bets to a 4-week high as of April 14th per Reuters, and silver bullish positioning also rose. Institutional accumulation is ongoing beneath the surface noise. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything I showed you today points to one thing. The structural pressure is already built. The COMEX coverage ratio at 13.4% and the Shanghai premium at 1067 are not opinions. They are exchange-reported data. The only question is when the paper market catches up to what the physical market already knows. Don't take my word for it. Verify every number I gave you today. Check the data yourself. CME Group official warehouse reports at cmegroup.com. Shanghai Gold Exchange benchmark data at en.sge.com.cn. Federal Reserve Fred economic data at fred.stlewisfed.org. Logic over hype. Always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. OG John AG 1.0 out.